Welcome to the Deep Dive. We're here to cut through all that noise and give you what you really need to know. Our mission today, well, it's to unpack the last couple of weeks in the economy and the markets, right through to Monday, June 23rd, 2025. So the big question we're kind of digging into today is the market seeing something the Fed isn't? Or is it maybe getting ahead of itself? Let's try and piece it together.
Exactly. And I think the core theme, really, the thing we'll keep coming back to is this push and pull. You've got the Federal Reserve being cautious, maybe a little guarded. And then you have the market, which seems to be shifting its expectations sometimes, well, pretty significantly. And all this is happening with, geopolitical stuff in the background and, of course, new economic numbers dropping all the time.
Okay, so let's start there with the geopolitical side. The situation with Iran was a big factor, wasn't it? How did that play out in the markets?
Yeah, it definitely was. I mean, there's still uncertainty, no doubt about it. But what seemed to happen, particularly by Monday the 23rd, was that investors got maybe less worried about how bad Iran's reaction might actually be.
Less worried about the scale of it.
Exactly, the extent of it. And that shift, you saw it almost immediately in the markets, a noticeable positive reaction, like a collective, sigh of relief, for now at least.
Right. So with that easing a bit, the main event, economically speaking, was the Fed meeting last Wednesday. What was the headline decision there?
Well, no big surprise, really. They kept interest rates unchanged. That was pretty much what everyone expected.
Okay.
But looking at their forward guidance, they're still penciling in 2 more rate cuts for the rest of 2025. That adds up to 50 basis points, or, half a percentage point total.
But here's where it gets kind of interesting, right? Because looking inside the numbers, there seems to be more disagreement among the Fed officials themselves now.
That's right. There's definitely a growing split. So last time, 9 officials saw those 2 rate cuts this year. Now, it's down to 8.
Okay, a slight shift.
But maybe more significantly, the number of officials who see no cuts at all this year, that jumped from 4 up to 7 now.
Wow, okay. That's a bigger jump. And what about their forecasts, the famous dot plot? What did that show?
Yeah, the dot plot. They actually trimmed their expectation for economic growth this year. It was 1.7%. Now they're seeing 1.4%.
Lower growth.
Lower growth. And at the same time, they actually raised their inflation forecast. It was 2.7%. Now they expect 3% for the year.
Okay, so the Fed's saying lower growth, slightly higher inflation, but we still think maybe 2 cuts, 0.5%. But the market heard that and reacted differently. How did expectations shift there?
Yeah, this is really fascinating. So even though the Fed basically repeated its expectation for 50 basis points in cuts, the market's odds of getting 50 basis points or less actually dropped.
Dropped.
Yeah, dropped significantly. It went from a 76% probability down to just 57%.
So wait, the market is now thinking it's more likely we get bigger cuts than the Fed is signaling?
That's exactly what it implies. It suggests investors are kind of reading between the lines. Maybe they're looking at that lower growth forecast from the Fed, maybe other data points, and thinking, things might slow down more than the Fed thinks, and they'll be forced to cut more aggressively later on.
Like they're betting the Fed will have to play catch up.
Sort of, yeah. It's almost like the market is challenging the Fed's slightly more cautious stance right now.
Okay, so with that backdrop of rates and growth expectations swirling, what did the actual hard economic data show? Let's talk about retail sales from Tuesday the 17th.
Right. Retail sales. They came in quite a bit weaker than expected, down 0.9% for the month. And remember, the previous month was already a bit soft, revised to minus 0.1%. So definitely a miss.
Was that mostly driven by, car sales? They can be volatile.
Cars were definitely a factor, yes. Lower auto sales pulled the headline number down. But importantly, even if you strip out autos, the ex-auto figure that was also really weak, it fell 0.3%.
And the expectation there was positive, too.
Yeah, analysts expected a small gain, maybe plus 0.2%. So seeing a negative 0.3% ex-autos, that points towards potentially broader softness in consumer spending, not just a blip in car sales.
Okay. And looking ahead briefly, any key data points coming up soon that could, confirm or maybe push back against this weaker growth narrative?
Yeah, definitely. This week, we get the final read on first quarter GDP growth. That's on Thursday. And then Friday brings the PCE price index. That's the inflation measure the Fed watches most closely.
And the expectation for those?
Right now, the consensus is that both will probably be pretty much in line with the previous readings. But, any surprise, especially on that PCE inflation number, could definitely stir the pot again regarding those rate cut expectations.
All right. So we've got geopolitics calming slightly, a Fed that's cautious but divided, some softer consumer data. How did all this translate into U.S. stock market performance over these 2 weeks?
Well, U.S. stocks were kind of mixed, really. They ended the period pretty much unchanged overall. We did see a pretty good rally late on Monday, the 23rd, mostly tied to that shift in thinking about Iran we mentioned earlier.
Right.
Looking at the specifics for the week ending Monday, large cap stocks were down just slightly, maybe 0.1%. Small cap stocks actually did okay, up 0.4%.
Interesting.
Growth stocks lagged a bit, down 0.5%, while value stocks were up 0.4%. And the NASDAQ, the tech index, was down about 0.4%. So bit of a mixed bag, really.
And oil prices, I saw they took quite a tumble.
They really did. Oil was down 3.7% over the full week, but the dramatic move was late on Monday, June 23rd, a sharp drop of 8.3%.
Wow.
And yeah, that lined up almost exactly with the stock market rally. It really highlights how sensitive oil is to those geopolitical risk perceptions shifting.
Makes sense. What about global markets?
Looking broader, world stock markets seem to underperform the U.S. a bit. Developed markets down 1.3%, emerging markets down 1.2%. But honestly, that underperformance might just be timing.
Because they closed before the U.S. rally?
Exactly. Most international markets would have closed before that late Monday surge in the U.S., so it's probably more about time zones than a fundamental difference in reaction, at least for that specific period.
Got it. Okay, let's turn to bonds. Often a telling indicator about economic health and rate expectations. What was the story there?
Bonds had a pretty good week, actually. They rallied. The key benchmark, the 10-year Treasury yield, fell by 13 basis points. It closed at 4.32% on Monday.
And lower yields generally mean higher bond prices, people perhaps seeking safety or expecting lower rates.
Generally, yes. And what's really insightful here is when those yields moved. Rates barely budged on Wednesday, right after the Fed meeting.
Huh. So the bond rally wasn't really about the Fed's announcement itself.
It doesn't seem like it. The fact that most of the yield drop happened before or after Wednesday suggests the rally was less about the Fed's specific guidance and more about those changing views on economic growth.
Yeah.
Maybe investors were keying off that weak retail sales number, seeing it as a sign of a slowdown.
Okay, so let's try and tie all these threads together. We've covered the Fed, the data, stocks, bonds, geopolitics. What's the main takeaway? The so what for our listeners?
Right. So if you boil it down, Treasury yields fell. High beta stocks, the riskier, more growth-oriented ones, they mostly underperformed the steadier low beta stocks. Small caps were kind of the exception, doing okay. And crucially, investors ended the period expecting more rate cuts from the Fed than they did just a week before, despite the Fed's own messaging.
So what does that combination point towards?
Well, taken together, it really suggests, I think, an increase in concern about slower economic growth starting to creep into the market's thinking. And maybe, counterintuitively, a bit less concern about inflation than we saw previously. The focus seems to be shifting more towards potential growth headwinds.
Definitely something to watch. The story's still unfolding. Keep digging into these topics, stay informed, and we'll be back soon with another deep dive.